Okay, welcome to today's Explainer. Today, we are diving into something absolutely crucial. We're breaking down Ray Dalio's incredibly simple yet totally brilliant template for understanding the global economy. If financial news usually sounds like complete gibberish to you, hey, don't worry, you are definitely not alone. We're going to strip away all that dense jargon and just look at the actual mechanical gears that run everything. Literally everything from your own personal wallet all the way up to Wall Street.
So Dalio's entire core philosophy boils down to the quote you're seeing right here. The economy works like a simple machine, but because most people don't really get it, we end up going through a whole lot of needless financial pain. Actually, by using this exact kind of unconventional template, Dalio managed to anticipate and completely sidestep the 2008 global financial crisis. It's built on this really fascinating idea that the economy is just made up of a few simple parts and a ton of simple transactions just repeated over and over and over again, all driven by basic human nature.
All right, here's our roadmap for today. We've got 5 parts. We'll look at the simple economic machine, the short-term debt cycle, the long-term debt cycle, how to actually survive a deleveraging, and finally, some basic rules for economic success.
Let's jump right into Section 1, the simple economic machine, building from the ground up. We're going to start small, right at the foundational building blocks.
So what exactly is the economy? It's a huge word, right? But to answer this, we literally just need to look at the simplest mechanical part. The economy isn't some magical, complex cloud. It's simply the sum total of all the transactions that make it up. If we can understand just one single transaction, we can figure out the whole shebang. And a transaction is just a buyer exchanging money or credit with a seller for goods, services, or financial assets. Every single time you tap your card to buy a coffee, you are creating a transaction. You are exchanging money or credit for a good. And total spending, meaning the actual cash plus the credit spent, well, that is the fuel that drives the entire economic machine. Now prepare yourself for a bit of a mind-bending reality check. Credit is the absolute biggest and definitely the most volatile driver of the economy. Just look at the US. There's about $50 trillion of credit floating around, but only $3 trillion of actual cash. So wrap your head around that. Most of what we all think of as money is actually just credit. It's created completely out of thin air, the literal second a lender and a borrower make an agreement, and bam, it immediately turns into debt. And this brings us to what is arguably the single most important rule of our economic engine. One person's spending, well, when a borrower gets credit, they naturally increase their spending, right? And spending is the fuel. Why? Because one person's spending is another person's income. This is absolutely crucial to grasp. Every single dollar you spend, somebody else earns. And when they earn more, that makes them look more creditworthy to banks. It creates this rapid, self-reinforcing pattern of growth. You spend more, someone earns more, their income goes up, so lenders are super happy to lend them even more money. They borrow, they spend, and the cycle just keeps spinning up and up. This is exactly why we have economic cycles in the first place. To put it in everyday terms, think of it like buying a beer. If you hand over cash, boom, the transaction is settled instantly. But using credit, that is exactly like starting a bar tab. You get the beer right now, which is great, but you're actually borrowing from your future self. You are basically guaranteeing that someday down the road, you'll have to drink less to pay off that tab. Okay, moving on to Section 2, the short-term debt cycle, the 5 to 8 year swing. Let's look at how pulling that spending forward naturally scales up into a very predictable cycle. Check out this timeline. Over a period of about 5 to 8 years, the central bank essentially acts as a referee. In year 1, credit fuels spending and prices go up. That's what we call inflation. To cool things down, the bank raises interest rates around year 3, making borrowing much more expensive. Because of that, spending drops, incomes drop, and prices fall. That's deflation, which leads us right into a recession by year 5. Then, to get the gears turning again, the central bank hits the gas by lowering rates, and around year 8, the whole cycle just starts all over again. But there's a catch to those short-term swings, which brings us to Section 3, the long-term debt cycle, decades of debt accumulation. Because human nature naturally pushes us to borrow and spend rather than pay things back, every short-term cycle finishes with slightly more debt than the previous one. We just love the boom times, so we push it. And over 75 to 100 years, this behavior inflates a massive, massive bubble. For decades, incomes and asset values just soar. People feel incredibly wealthy. It's a party. Until we hit around decade 75, the long-term debt peak. This is when debt repayments finally start growing faster than incomes. Suddenly, spending is slashed, credit totally vanishes, and the entire system just crashes inward. This is exactly the kind of massive reversal we saw in 1929, in 1989 in Japan, and of course, the 2008 crash. Now, you might be wondering, how is this different from a normal recession? Well, look at this comparison. This is the terrifying difference between a standard recession and a deleveraging. In a recession, lowering interest rates is like flipping a switch to get the gears moving again. But in a deleveraging, the debt burden is so incredibly heavy that the central bank's main lever completely snaps. Interest rates are already at zero. They literally cannot be lowered any further, and the whole economy basically becomes uncreditworthy. So how on earth do we fix a machine that broken? That is Section 4, Surviving a Deleveraging, the 4 paths. When borrowers are crushed by debt and lenders just flat out stop lending, policymakers absolutely have to step in. And it turns out every deleveraging in modern history follows these 4 specific mechanical steps. First, there's painful austerity, meaning cutting spending. Second, you see massive debt defaults and restructuring. Third comes the really controversial part, the redistribution of wealth, usually from the rich to the poor, through taxes. And finally, step 4, the central bank is forced to step in and literally print trillions of new dollars, completely out of thin air.
As you can imagine, this creates an incredibly delicate balancing act. Look at these forces. Those first 3 steps, cutting spending, defaults, taxes, they are highly deflationary and, quite frankly, really painful. To stop a total economic collapse, that deflationary pain has to be perfectly offset by the inflationary force of printing new money. It's the only way to maintain stability. And it all comes down to a magic number. Say the interest rate on a country's debt is 2%. The central bank has to print just enough money to push the rate of income growth higher than that 2%. It's just simple math, right? Your income has to grow faster than your debt, otherwise, that heavy debt burden is never, ever going to shrink.
Now, if policymakers actually manage to pull off that perfect balance between deflation and inflation without accidentally triggering hyperinflation, we get what Dalio calls a beautiful deleveraging. This is where debts finally decline relative to income and real economic growth turns positive again. Now, it does take roughly a decade or more for those debt burdens to fall. You'll often hear it called a lost decade. But if handled perfectly, the machine gets fixed and starts humming along smoothly once again.
All right, let's wrap this up with Section 5, Rules for Economic Success, Ray Dalio's template. We're going to extract the 3 ultimate rules of thumb for navigating all this. Okay, whether you're just an individual managing your own household budget or a policymaker running an entire nation, following these 3 rules is absolutely vital. Number 1, don't let your debt rise faster than your income or those debt burdens will eventually crush you, for sure. Number 2, don't let your income rise faster than your actual productivity because you'll eventually become uncompetitive. And number 3, do literally everything you can to raise your productivity because at the end of the day, in the long run, productivity is the only true driver of wealth. So, as we finish up here, I want you to look at your own financial reality through the lens of this simple machine. Ask yourself this critical question. Are you letting your debt rise faster than your income? Are you building actual productivity, or are you just running up a massive bar tab with your future self? Look, this economic machine is going to keep turning no matter what. The only real question is whether its gears are going to work for you or crush you. Thanks so much for joining me on this explainer, and I'll catch you next time.